Okay, let's just dive right into this, because we are looking at a truly fascinating contradiction today. One of the most polarizing figures in modern finance is betting the absolute house on an AI shift that, well, almost no one else sees coming. In this explainer, we're unpacking the strategy of Cathie Wood. Yeah, the CDO of ARK Investment Management. We all know her for hunting those high-growth tech unicorns, right? But right now, she's making a high-stakes, multi-million-dollar move on a stock that has the rest of the market seriously scratching its head. So we're going to decode the exact timeline, the massive cash burn, and the specific macroeconomic secret she actually thinks will turn her fortunes around.
But first, to really understand her current moves, we've got to confront the sheer scale of wealth destruction right out of the gate. I mean, look at this. According to a Morningstar analysis, from 2014 all the way to 2024, ARK managed to wipe out a staggering $7 billion of investor wealth. That actually netted the third biggest wealth destroyer among mutual funds and ETFs in that entire ranking. $7 billion? When you lose that kind of money, it puts enormous, let's call it character-building pressure on your next moves. It totally shifts the lens through which we have to view her current investment strategy. And you can see this painful tailspin crystal clear in our flagship fund, the ARK Innovation ETF. Just look at the 5-year annualized return. Her fund is sitting at a negative 8.42%. Meanwhile, the broader market, tracked by the S&P 500, was just cruising along at double-digit gains of over 11%. Even if we just look at the year-to-date numbers as of early July, her fund is lagging way behind the broader market surge. Her style, it brings massive rewards in a bull run, absolutely, but it delivers incredibly painful losses in bearish markets.
So unsurprisingly, investors have been reacting to these numbers. Over the past 12 months alone, the ARK Innovation ETF saw roughly $1.25 billion in net outflows. People are just taking their money and walking away. But here's where the story gets really compelling. Despite bleeding over $1 billion, Cathie Wood is not flinching. No way. She isn't retreating to safe, conservative bets. Instead, she's doubling down on her aggressive tech thesis in a way that literally has Wall Street doing a double take.
And that brings us to this highly specific, highly aggressive trade. Wood's ARK funds just scooped up 34,080 shares of Meta Platforms. Based on the closing prices at the time, that's a position worth about $22.8 million. But what makes this trade so wild isn't just the amount, it's the timing. She didn't buy Meta at the bottom of a dip. No, she added these shares even as the stock had just surged nearly 15% in a single week. She is actively buying into the momentum of a mega-cap tech giant, just piling on positions amid incredibly strong gains.
So the crucial point here is trying to understand exactly where Meta fits into her broader vision. If we break down the top 10 holdings of the ARK Innovation ETF as of mid-July, you've got Tesla dominating at over 10%, followed by names you'd expect, like Tempest AI, CRISPR Therapeutics, and Robinhood. But notice who's missing. Meta Platforms doesn't even crack the top 10 of this fund yet. So you really have to wonder, why is a renowned growth hunter aggressively buying tens of millions of dollars of a trillion-dollar social media giant that isn't even a core pillar of her portfolio yet?
Section 1. The deflationary AI secret.
To really grasp this massive bet on Meta, we have to dig into her radical macroeconomic thesis, which is this idea of a deflationary boom. Now, while you and I might be paying more for gas or groceries right now and feeling that inflation sting, Wood actually believes we're standing on the precipice of a massive deflationary wave, all triggered by artificial intelligence. The big idea is that AI is going to dramatically increase productivity across almost every single sector of the economy. And, when you can produce more stuff for less money, goods and services actually become cheaper. She's hunting for the specific companies that will drive this exact technological revolution.
In a recent post on X, she actually laid out her evidence for this, and she pointed directly at the bond market. She noted that despite a really sharp rise in oil prices over the past year, which, as we know, is an energy shock that traditionally pushes long-term yields higher, the Treasury yield curve has just continued to flatten. She argues that the bond market isn't sweating inflation at all. It's already pricing in this massive tech-driven productivity shift. Essentially, the market is whispering that AI is going to fundamentally drop the cost of doing business. If her theory about the bond market is on the money, she predicts this next phase of the economic cycle will bring a very specific set of conditions. We're talking accelerating economic growth paired with declining inflation, which naturally leads to falling interest rates and a strengthening US dollar. This specific combo, it creates a remarkably supportive backdrop for the exact type of innovation-led equities that she champions. She's positioning her funds right now, basically hoping this deflationary boom will be the catalyst to bring back those staggering triple-digit glory days she saw back in 2020.
Section 2. Meta's massive AI gamble.
But there's a massive crack in this plan, and it brings us right back down to the reality of what's actually happening inside Meta. They are currently burning cash at a totally unprecedented rate. To power this AI future, they are expected to spend up to a staggering $145 billion on AI infrastructure just this year alone. That makes them one of the biggest AI spenders among all of big tech. I mean, this is a monumental financial gamble. Investors have rightfully been questioning whether this historic level of spending will actually translate into meaningful, tangible returns anytime soon.
And the climax of this high-wire act? Well, it comes straight from the top. Mark Zuckerberg recently admitted in a leaked internal town hall that their AI reorganization hasn't exactly gone to plan. He flat out told employees that their AI agents are developing much, much slower than they anticipated. Think about that for a second. You're pouring up to $145 billion into infrastructure, but the actual artificial intelligence you're trying to build isn't evolving anywhere near the speed you projected. Yikes.
So, Meta is currently caught in this massive tug-of-war between innovation and reality. On one hand, they just launched Muse Spark 1.1, an AI coding model that acts as their very first paid enterprise AI product. It's meant to compete with giants like OpenAI, right? Which is a huge step forward for monetization. But on the other hand, the core agentic development is slowing down. Cathie Wood is throwing millions at a company that's still trying to figure out if its $100 billion infrastructure is actually going to talk back to us on schedule.
Section 3. Bridging the AI gap.
So how does Meta survive this gap? How do they bridge the distance between this massive cash burn and a delayed AI revolution? Well, the answer lies in the sheer strength of their traditional business. Wood is betting that Meta's underlying core foundation is going to keep the ship afloat. Just look at their first quarter. They reported revenue of over $56 billion and an adjusted earnings per share of $7.31, which completely crushed Wall Street estimates on both metrics. They just have this massive cash engine that can fund these wild AI ambitions. Well, at least for now. And analysts at Wells Fargo, they entirely agree with this timeline, outlining what they call a catalyst path for the second half of the year. Step 1 of this path is maintaining that robust ad growth from their core social media platforms. Step 2, and this is a really crucial one, is their plan to lease out their excess AI computing capacity to others. And step 3 is successfully monetizing new enterprise AI products, like that Muse Spark we talked about. This is the strategic bridge that's going to sustain them while those AI agents take a bit longer to train.
The strategic bridge is exactly why Wall Street is not running for the hills. In fact, Wells Fargo analyst Ken Gorelski recently raised his price target on Meta from $765 all the way up to $767, maintaining an overweight rating. They expect Meta to reaffirm its aggressive spending plan, sure, but also soothe investors by providing actual details on how they'll lease out that excess computing power. So Wood isn't the only one seeing a light at the end of the tunnel here. Institutional money sees a really clear path to profitability as well.
Section 4. The ultimate productivity boom.
As we look ahead, we're basically staring down two very different competing timelines. Mark Zuckerberg told his employees that despite the delays, he still expects more meaningful returns from their AI investments within the next 3 to 6 months. He's looking for some relatively near-term validation of their massive spending. Cathie Wood, on the other hand, is playing a much longer macroeconomic game. She's betting on a systemic, long-term deflationary boom that could completely redefine the economy and validate her entire portfolio, not just this recent Meta purchase.
Ultimately, this leaves you with a critical decision as an observer of the markets. With historic wealth already destroyed and Meta's AI agents lagging behind a $100 billion infrastructure bill, you have to ask yourself, is Cathie Wood seeing a visionary, world-changing productivity boom that a frightened market is completely blind to? Or is she throwing tens of millions of dollars at the absolute peak of an AI bubble right before it bursts? How these timelines collide is absolutely going to define the next decade of tech investing.